In this video, I wanted to show how easy it is to enter the data, walk through my process of how to do it. I don't have the tax return on the screen to share it, just to keep the client's information private, but I did want to walk through an example, so I will verbalize what I'm doing as we go through. So step one is to make sure you select the filing status. You can have a different filing status from year to year. If they're married, expected to be married in next year, then you keep that there. Step two is to enter the age of the taxpayer. So this would be the person listed as taxpayer on the tax return. There is no age, there's no date of birth on the tax return. So you would either have to know it if it's yourself or if you're working with a client, know their age at the end of the year. So just to keep it simple, let's just say 64 this year, and next year will be 62. So the program does automatically update to say, hey, number of taxpayers age 65 and over. So as we see in 2021, they will both be 65, so therefore it increases to 2. This matters for the standard deduction. So having the age of end of year matters substantially when you're in the around the 65-year-old age. It barely matters any other time. So make sure to have that entered if you're around that 65 age. So now take the tax return, open in another screen, and look at wages. So this, as we see on the left-hand side, aligns with the tax return, so you can follow those numbers, those sections. So wages on this was 73.64. They were tailing off their working at the end of the year. Tax exempt interest, they had $111 and didn't have any taxable interest. I'm using the tab key to move between each box, so that makes it a little quicker for data entry. Qualified dividends. So this is important because qualified dividends are part of the capital gain income bucket. So it's important to have this input correctly. And then the ordinary dividends is the amount that would be taxed. The difference between this account, this box, and this box is the amount that's calculated as part of ordinary income. That's just a FYI. It automatically does that in the program, but just to let you know, that's how it works. So next is they have capital gains. So capital gains on the first page of the 1040 is one line item. So you do have to jump to Schedule D to see the difference between net short-term capital gain and net long-term capital gain. So in this example, we have negative 67 short-term and 9,387 for the long-term gain. And then it nets here to that. Just to show you, if we had this as negative 10,000, it does cap it at the $3,000 loss. So next is to go back to the first page of the 1040. We see here, hey, there's information, yes or no, for Schedule 1. If there is, then you need to go to Schedule 1 and enter that information. So they did have a rental property. And if they had, let's just say they had another number here, you would see, you could enter that, and it nets it all down to what your total adjustments are to get to your adjusted gross income. Go back to the first page of the 1040 after we get through Schedule 1, and we see here they actually had charitable contributions last year. They got the $300 charitable contribution benefit for non-itemizers. And then we have their adjusted gross income. If they itemize, we'd fill that by jumping to Schedule A, but they did not itemize, so we go to the standard deductions automatically calculated. Qualified business income is not, there's not a worksheet for that right now, so you'd want to enter exactly what they had. The program automatically assumes the same next year until we get that adjusted. In this bottom section here, we should tie here to regular income tax within plus or minus $10 for general rounding between the different softwares, because different tax returns round a little differently. So if we're within $10, that's good enough because we're looking big picture here. Precision's not required as long as you're within a few bucks. I mean, over that, then there's probably data entry input. And that's where you'd want to go back through and check that. If they had Medicare tax that wasn't calculating, let's just go up here and say this is 300,000 of earnings. The program does calculate Medicare tax, but it may not calculate everything. So I have a little note in here saying our net investment income tax only includes our interest, dividends, and capital gains. Sometimes rental properties should be involved. And in this case, this one would have rental property involved here. So if they actually were subject to the net investment income tax, I would need to add that manually. The other part is the Medicare tax on earnings may need to be reflected here. And, sometimes it may be a negative number because of the married versus single. It's, use that, and you can look at the Form 8559. But at the end of the day, these have limited impact on the grand scheme of things, so don't worry too much. If you want to actually calculate your withholding or the actual refund or not, you can add in your with tax withholding, estimated payments, and then some of the obscure credits. The program does calculate the child tax credit. It does not calculate other credits such as the foreign tax credits, so just add that number in there. Those stay pretty static. The AMT credits, energy efficiency credits, those don't calculate into here. Those matter for when you actually pay your tax bill. It does not matter when you're doing this type of big picture planning here. Middle column here, these would be the adjustments. So if this person's retiring next year, you would have that adjustment in there. If they're retiring, maybe they're going to have more capital gains because they may take out more from their portfolio. You add that in. Maybe next year they're planning on making some bigger donations. So now all of a sudden their tax payments matter, so you need to enter that in. I mean, that caps at 10,000, so many people will be already capped unless you're in a no state income tax place or rent. If they had that, if they had a mortgage, make sure to have that, and so on and so forth. So now all of a sudden they're itemizing, it changes all that. So then next is the 10-year tax bracket manager tab. This takes everything, grows it by inflation. You can set your inflation rate here on the first tab of 2%, and then because that will impact how the tax brackets are also influenced. So each tax bracket will grow with a standard inflation rate. However, you can change what that inflation rate is projected to be because maybe you think it's going to be more aggressive tax changes. I do have a box here for Social Security and what the inflation rate there is because you may have a different belief on how that grows specifically because that one's a little bit more of has a political time clock related to it, so that may matter. So there's preference there. Program assumes same filing status for the next 10 years. That's a future update that we may make. Otherwise, you can make changes here, manually input, if you're going to do Roth conversions at a certain point or other retirement income at a certain point. The program does automatically calculate required minimum distributions when you fill out the Roth conversion analyzer tab. Social Security, the timing there matters. Capital gains, maybe they're going to sell their rental property at some point, so you want to include that. Because that helps us, build out our long 10-year projected tax bracket. So when we go to the bracket breakdown, you can see that trend because we can see the details of 2020 and 2021 for those very strategic decisions that we make from year to year. And then we're going to see the trend line over time. In this case, the trend line says once they retire, they're going to be in a very low tax bracket. Assuming they have investments, they may see a peak up there. So I'd say at this point, this one's incomplete. You want to make sure to enter that. I'm going to skip this DC FSA versus DC TC tab for now and jump to the Roth conversion analyzer. So here, probably step one that you want to do if you're working with a retiree or if you are a retiree is enter your information. So say the taxpayer has $1 million IRA, $50,000 Roth, and $150,000 investment management account. Enter all that. Add a projected growth rate. I'll just use 5 for all of them just to keep it simple for growth rate. This asks us to make sure we enter our Social Security benefits in years 3 through 10. And that is important. And this isn't a required field. It's more of a, yes, I entered it. Because at the end of the day, this Roth conversion analysis may not matter if you don't enter it. So if we go back here, say one spouse will take their benefit at 67, say it's 30,000. The next one starts and it's 36,000, and when they're 70. So we go back here. Yes, I did do that. Will they be taking distributions out prior to RMD age, not including Roth conversions? That should be reflected here because it does impact what the future RMD would be. For the spouse, let's just say they all have the same balances. If the taxable, let's say it's a joint account, you can either split it if you'd like, or you could just leave it as just one spouse having it. This box doesn't matter. IRAs matter because of the ages and who they are. So make sure, yes, I did enter in the Social Security benefit, no RMDs. So this calculates our effective RMD tax rate, as we discussed in the Roth conversion video. We walked through the rest of how this tab works. 2017 tab is automatically filled. You can have a different start year if you'd like. So say the default's to what the age 72 tax year would be, aka the RMD year. If you wanted to start a different year because it makes more sense, you can do that. Just type in -1 if you want to go back a year, or +1 to start a year earlier. Next is want to increase the tax brackets by a CPI rate. So tax brackets do typically follow a CPI rate increase. So the brackets aren't always, the 15% bracket is not always $80,000. It'd be 80,000, 100, 80,000, 83,000, so on and so forth. So if you use a CPI rate of 2%, then it'll reflect that in the tax calculation, which matters on the actual tax bill paid. So that's a personal preference as an option there. And ultimately, this calculates based on the 2017 tax law and as discussed in the Roth conversion tab of its importance. So that's the basic of all these other tabs. Now, if you had a situation where you have a young family or you're using a dependent care FSA or eligible for the tax credit in 2021 specifically, and maybe this gets extended beyond this, but you can add in analysis to determine, does it make more sense to put money in a dependent care FSA or just take the tax credit? So over here back in the tax bracket management tab, you need to enter the age of your dependents, which is say 2 and 4, and then it'd be 3 and 5, and the dependent care is say 12, not 120, maybe in some states, not in all. And it's a little cheaper for the older one. Dependent care FSA, I didn't, and say they did make a $10,500 contribution, could be any amount. Probably should bring back the wage there. And continue, and it calculates an automatic federal income tax benefit. And if you have a state, you need to add the state income tax, and you can do a comparison of, does it make sense to do the dependent care FSA or not do it and do the dependent care tax credit. So in this case, it's an obvious do the dependent care FSA because of the substantial savings difference. But overall, that's how to input and utilize the calculator and navigate through it. If you have any questions, please send me an email or reach out with questions. Thank you.